Unfortunately, none of us have a crystal ball to determine where the markets are headed, but our next guest, Gary-Wagner of the Gold Forecast, says we can use charts and resistance and support levels to help determine where the market might go next. Gary, thank you so much for being with us.
Thank you. So nice to see you again. Good morning.
Gary, as you know, we get a lot of viewer emails, and investors often write to me asking if the markets do move downwards, how low can we go, or vice versa. Obviously, there's no way we can look into the future, but is there any way we could anticipate certain patterns in the market?
Absolutely, absolutely. You know, whenever you watch technical analysis and technicians plot what's called support and resistance, for the most part, we're using a couple of different techniques. The first technique is we're looking for historical data points in which the market reacted in a certain way, whether it's supportive or it finds resistance. And the second type of support and resistance that we chart is simply called Fibonacci Retracement. When you combine them together, it's a very, very powerful tool.
All right, Gary, so now you will walk us through support and resistance levels with the help of a chart, correct?
Absolutely. It's an oversimplification, but hopefully it will enlighten those that are looking to understand more about technical analysis.
All right, so let's get started right now, Gary.
You know, a lot of new traders really want to learn about charting the market and technical analysis. Today I wanted to take a look at support and resistance areas and how we technicians actually go ahead and plot it. There are two basic techniques that we combined for the most part when looking at support and resistance. The way I like to look at support and resistance is they are part and parcel of the same thing, meaning if you are on the first floor and you look up, the ceiling above you, of course, is resistance. But if you're on the second floor looking down, you're looking at the very same structure, but it is supportive. It's holding you up. And resistance and support work identically in the same way. Let's take a look at this market when it ran from $1,300 to just over $1,900, this historic rise. And what you can see in this is as the market went up, when it hit roughly the $1,500 area, you saw it really came into its first level of resistance. In other words, you can see it attempts, it comes in, it makes a new high, trades back down. It trades roughly in the same area, 1536, cannot break through it, and then comes back down. At that point, we had literally a parabolic rise as the marketplace went up. And it hit this new historical high, 1920. Now, once those targets are in place, we have some good information that we can actually start to use to our benefit. First of all, we're plotting a Fibonacci retracement. Now, the retracement is simply where we look at the beginning of the rally and the end of the rally, and then we divide that space up into 23%, 38%, 61% in terms of retracement levels. But to simplify what I'm talking about, you can really see the fact that we have resistance here. The market comes up. When it comes back down, you can see that these areas now become supportive of the price point in gold, meaning the 1530, 1520 area is now support. Support and resistance, one in the same.
Gary, thank you so much for that. I think our viewers will appreciate it.
You're very, very welcome.
Are there more educational series to come, Gary?
Absolutely. I want to touch upon candlestick charts, another type of Japanese chart called Henkin Ashi. I want to talk about that, and some other Western technical indicators, stochastics, moving average.
All right, Gary, thank you so much for that.
You're very welcome. Have a great day.
And thank you for watching this edition of Kitco News. We hope you enjoyed it. You can email me at newsfeedback@kitco.com. For Kitco News, I'm Daniela Cambone.